The next bullet point I think is very important because it's really outside the norms of United States tax procedure. Typically, the way tax works in the United States is we have something called tax court. It sounds like the title of a TV action drama, tax court. It's not really that exciting. But basically, the way tax court works is that if the Internal Revenue Service assesses a tax on somebody, they typically have two choices. What they can do is they can either pay the tax, and then they can file for a refund, and then if the IRS denies the refund, they can go to an ordinary court, a district court, or there's a specialized court, and sue to get the money back. Alternatively, and frankly, this is the route that the vast majority of tax litigation goes through, is something called tax court, where you file a petition with tax court, and that precludes the IRS from collecting the tax. Once that tax court petition is filed, they're not allowed to go after you. And then during the course of the litigation, you argue in tax court, which is a specialized court. All the judges there do nothing but tax cases. So it's generally perceived as a forum that has more tax expertise. It's a specialized court, and obviously most taxpayers find it advantageous to argue first, pay later, as opposed to pay first and argue later about whether or not to get the money back. So that's generally perceived as a very favorable forum. For some reason, and again, this goes back to the issues regarding stamp tax, when they wrote the law setting out the types of cases over which the tax court has jurisdiction, insurance premium tax just didn't make the list. And there's no doubt in anybody's mind that it didn't make the list, not for any reason that anybody thought that it was a bad idea to litigate those cases in tax court. Just nobody thought about it. It was some tax back in the back of the book that nobody knew about, and it just didn't make the list. But as a result of this sort of inadvertent omission from the list of types of taxes over which the tax court has jurisdiction, the end result is that if the IRS goes to a person and says you owe a tax for federal excise tax, there's no way out. All you can do is pay the tax. You can then sue for a refund, and the IRS has a certain amount of time to decide whether or not to pay you. And if, as they typically would not, they would typically deny the refund, you can then go to an ordinary court, a federal district court, and sue for the money back. It's a much lengthier process. It's very time consuming. You end up with a judge who is not a specialized tax judge, which may be helpful, but it's certainly different. But most importantly, you have to pay first and argue later. The other piece that I think is just really receiving a lot of attention is who is liable for the FET. And in a series of regulations that were issued in the early part of the prior decade, the IRS clarified that both the insurer and the insured are jointly liable for FET. And I think this has come as somewhat of a surprise to a lot of people. People have always assumed that the purchaser of the insurance or the purchaser of the reinsurance, the person who made the payment was the one who had the sole liability for the FET. And in fact, that's not the case. And because of the fact that the IRS does have jurisdiction over any assets that are located inside the United States, there is the possibility that if you're a reinsurer, you have investment assets that are inside the United States, that the IRS could subject those to lien or levy if the IRS does assert that there's an unpaid liability for federal excise tax, even if that liability was one that should have been borne by a ceding company, and even if the ceding company told you that they paid the tax. It's a question that comes up a lot in the reinsurance industry, where typically in a treaty, typically a treaty will provide for the payment of premium, and what they'll say is that the ceding company will withhold 1% for payment of the federal excise tax in those situations in which a tax treaty does not apply. And you kind of always assume that if they keep the 1%, that they'll actually pay it. And in fact, I think generally they do. But if they don't, you're still on the hook for it, which is something that most people, I think, had not really taken into consideration.
So just on the statute of limitations,
sure.
If you file a nil return, does the statute still start?
Yes, you can file a protective return showing zero liability, yeah.
Excuse me, what about the broker, the insurance broker?
I tend to think that the broker does not have federal excise tax liability. However, if you read the regulations, there's a fair amount of fuzzy language in there about people who make the policy. I suspect that the IRS believes that there is potential liability by the broker. I haven't seen them pursuing brokers yet for unpaid FET, but I would not be surprised if that was a possibility in the near future. The language of the regulations is fairly unclear, I would think, about whether or not the broker has potential liability. Another little bit of FET trivia that doesn't come up until you actually sit and read the rules and then sit at your desk in horror. How do you calculate how much is due? Well, the federal excise tax talks about the policy. It says the policy, federal excise tax is due as a percentage of the premium paid on any policy, and they talk about an insured, which is basically a U.S. person for risks that lie wholly or partly within the United States, or a non-U.S. person engaged in business in the United States for any risks within the United States. And I don't want to go to this one yet because it's too scary to think about. But let's say you have a U.S. person. So you have a U.S. corporation, and it has an insurance policy. And it covers risks that lie, some of which lie within the United States, some of which lie outside the United States. And let's say, for the sake of argument, let's say 95% of the risks lie outside the United States. Well, the IRS says, well, 5% is partly, so there's a FET due on that policy. And by the way, there's nothing in here that says anything about allocation of premium between the US and the non-US components. All it talks about is the insurance policy subject to FET, or is it not subject to FET? So if it is subject to FET because it's a policy covering a U.S. person against risks that lie partly within the United States, it's subject to FET. And I think it's interesting to go back to the first slide that we were talking about, where we were talking about the roots of the excise tax in a stamp tax. You could sort of picture a situation, back in the 1890s, where a cotton broker was going to purchase an insurance policy on his goods, that there wouldn't really be any allocation, because what you would do is you would look at the insurance policy, you would look at what premium it called for, and you would go to your bank and you would buy a stamp for 4% or 1% of the amount of the premium, and that would be pretty much it. There's nothing in a stamp-based tax that really provides for or calls for allocation of premium. And now that we've gone to a tax that is being applied in a more modern context, where we have much more complex insurance structures, where we have returns. The roots of the tax back in the old stamp days really, I think, is coming up to haunt us, because that language has really been around for quite some time. Page down. So how do we respond?
Just for an example, so if you wrote or reinsured a book of life policies from Mexico, and a couple of people happen to be U.S. citizens who happen to be working in Mexico at the time.
It would depend who the insured is. If the insured is a U.S. person, the IRS would argue that whole policy is taxable. If it's a non-U.S. person, that gets into the second bullet, and it gets a little quirky there. I'm not quite sure what the answer is. I'm not sure what the IRS thinks the answer is. But I know what the IRS thinks the answer is in the other situation. Okay. So what happens when you're sitting here in Ireland and you open up your mailbox and suddenly you get an information document request from the IRS? So with due respect to Elizabeth Kubler-Ross and the 5 stages of mourning, I thought I would borrow the concept a little bit and say, what really happens when this process starts to take place. So the first thing that everybody says is, "Oh, this can't be happening to me. I'm not in the U.S. I didn't even open this envelope. I don't know how they found me. I don't know how they got me. But this really can't be happening." The second, this is followed very, very quickly by anger. This isn't fair. And my reaction to that is, yeah, you're probably right. It isn't fair. Bargaining. There is some bargaining that goes on. I'm not quite sure how that relates to one of the stages of mourning. There's a lot of depression going on. That is absolutely sure. But I think in my experience, ultimately, after what typically happens, especially in larger organizations, there's a lot of internal debate as to what people should do next. I've heard a lot of expression, bargaining. I've heard a lot of depression, but anger, I think, is really one of the predominant reactions. I've heard some of my clients refer to it as the federal extortion tax. So there's a lot of people who really get very upset about this because it's not a tax that makes any sense. It's not a tax that really is fair. And it's not a tax that anybody really expected to pay. But I think at the end of the day, what most people come out down to is really acceptance, which is that for the most part, there's a lot of people whose ties to the United States are such in terms of related parties, in terms of investments, in terms of just all sorts of things. Reinsurance is a very worldwide interconnected industry. And at the end of the day, I think most people have come to the conclusion that, I can't fight it, I may as well prepare for it, which is how Elizabeth Kubler-Ross dealt with impending death.